Chapter 10, Fundamentals of Cost Management. So we start this chapter of the fundamentals of cost accounting with a review and an overview of the information that we use for decision making. We've been doing a lot of calculations in previous chapters, and we'll do more in this chapter, of course. But this chapter goes a little bit more in-depth in how these calculations are analyzed and used by managers in decision making. And we start by talking about ABC, or activity-based costing. And as we've already seen, some companies will allocate costs to departments arbitrarily, and some of them will allocate based on activity. And as we already know, when we're allocating costs based on activity, it tends to be a little bit more precise, and you get more accurate numbers than if you just allocate per department. So, for example, let's say a company has two departments, Department A and Department B, and they have overhead costs. And they can allocate costs to each department 50-50, right? And some of them, some companies do that, but that might not necessarily be accurate. You know, in some companies, the departments are vastly different. One department might be much more active or do more business than the other department, so to split overhead 50-50 wouldn't be too fair. The company could also allocate based on production. So remember in the prior chapter we talked about a company that produces both personal computers and business computers. And the personal computer department, if you recall, dealt with a lot of complaints. They had a lot of customers that complained about their orders. The business department had some complaints as well, but percentage-wise, it was a lot less than the personal computer department. So it wasn't fair that the costs that arose from the complaints, because you know when you have complaints, you're going to have a guest service department or a manager or whoever it is to deal with those complaints, and that costs money, of course. And it wasn't fair to allocate those costs 50-50 between the personal computer department and the business computer department, because they incurred a different level, different number of complaints. So that's all ABC is instead of having one large overhead account, we split it up into costs based on certain activities. Like I mentioned in the prior example, that there were costs that were tied to complaints, and then we allocate according to those activities. So it becomes easier to manage the costs. You know, when you can identify more closely where the costs are coming from, then you can also manage it better. You know, so the first step is to gather the information, the pertinent information, and split it accordingly. And then once you have the information, then you can act intelligently in reducing those costs. So the first step in ABC management is activity analysis. So activity analysis, as the slide shows, has 6 steps. And the steps are very logical and intuitive, or they make sense. So you don't have to memorize these, but read through them, and you should notice that they're very logical. So the first one is you can identify what the customer wants or expects from the firm's products. Then you chart out the entire process that the product goes through. You develop ABC data for each activity based on the resources in each activity. Then you look at each activity and determine whether they are value added or non-value added. You compare the cost of each activity with the value that the customer is assigned to it, and then you improve the efficiency of all the value added activities, and you eliminate or reduce the non-value added activities. So what does that all mean? Well, it's usually easier to explain in an example. So let's say, for example, that we have a meat market, and this meat market makes sausage. All right. Now, when you're making sausage, there's a lot of steps that are involved that the meat market goes through. The meat market sells sausage, but it might sell other goods as well. So let's say let's talk about the process to get from the animal, like the cow or the pig, into sausage. All right. So so when you follow the steps, you look at you start with the animal, you butcher the animal, you chop it into its different cuts of meat. You might choose certain cuts to grind into sausage. You add spices, you case the sausage, and then finally you have the finished product. So when the meat market is determining whether or not to sell sausage, or maybe they're just going to sell the cuts of their meat, they're going to look at, they're going to break down the process, every step of the process. They're going to determine what adds value to the products and what doesn't. And then they're going to determine whether or not it's cost effective, if it's getting them extra money, extra profit. And if it doesn't, maybe they don't decide to sell sausage, or if they're making quite a bit of money, then they will decide to sell it or to sell other cuts of meat. All right. So again, put yourself in the manager's situation. Of course, the manager can just sell a whole carcass, a whole cow or a whole pig, and 30, 40 years ago, that's how they did it. Meat markets would sell these whole animals to restaurants, but then they decided that they found out that a lot of the restaurants, a lot of the people that bought the meat, they didn't know how to cook certain parts of the meat, and some of it was getting thrown away or just not treated correctly. And so they came up with the idea of boxed beef. So the cow became after the cow was butchered, the cow was chopped up into its different cuts, and the butchers found that they could sell more beef that way, because people knew what they wanted, and so they could just buy certain cuts of beef. The butchers would charge a little bit more for that service, but at the end, the customers were happy and the butchers were happy because they were making more money. So that's pretty much the concept. Again, the butchers can just sell a whole cow for a certain price, but if it takes some additional steps into cutting up the carcass and selling it per cut, then it can add value to each pound of beef that they're selling, and then that would boost the bottom line profit of the butcher. In Chapter 9, we saw that in the ABC system, the first stage allocates to activities, not departments. We're going to allocate to activities in the ABC system. So now we see why that might seem like a small difference, but it has big implications for cost management. So, for example, on this slide, it shows that costs that are strictly volume related That means that, depending on how much business that they're doing. Those can be controlled by focusing on the volume of units. So things like lubricating oil or machine repair, if you're producing a high amount of products, then you're also going to have to pay for a lot more lubricating oil, a lot more machine repair, etc. So those costs are directly related to volume. I suppose if you didn't want to incur more lubricating oil costs, you would also stop selling as many products or stop producing as many products. So that's a way to control your costs directly, but probably not a smart thing to do. But theoretically, if you wanted to control the cost of your lubricating oil, your machine repairs, you could theoretically stop producing so many products. All right. On the other hand, we have facility-related costs. Now these are exact opposite. They're not volume-related at all. These are essentially fixed costs. You have your plant costs and your admin costs. And as we've talked about before, fixed costs, those require a longer time to change. Ultimately, every single cost in a business is variable, but in the short run, there are some that are fixed, like rent. If you've signed a 3 or 4 year lease, that's going to be a fixed cost. Or if you buy certain machinery and you have an operating lease on those too, that would be a fixed cost. So we have two extremes here. We have the volume-related costs, which are directly related to your production. We have facility-related costs, which are not related to production at all. They're fixed costs. And then we have batch and product-related costs, which are affected by the way managers manage activities. You can also use ABC in assessing customer and supplier costs. So if this looks familiar to you, it's because it's the same process we did in previous chapters. So this is one of those things that it's just a review of what we've already done. So when we're trying to control our customer and supplier costs, the first thing you do is identify the activities that consume resources. Then you identify the cost driver associated with each activity. You compute a cost rate per cost driver, and then you assign the costs to the customers using the formula that we already know. You take the cost driver rate, multiply it by the volume. So again, it's something that we've already seen before, so it should look very familiar to you, and we'll work these problems in our homework. All right, one distinction that we need to make clear here is the difference between resources used and resources supplied. So for resources supplied, that's wrong. This should be a D. For resources supplied, that's resources that you've paid for. You paid for them, but you didn't necessarily use it. And then resources used, as the term indicates, it's resources that you actually got use out of. Okay. So in the book, there's an example of truck loaders. Truck loaders, they're just people who load items to be delivered onto delivery trucks. So they could work for UPS or the post office or FedEx or whoever. In the book, it gives an example that you can hire a temp worker, $2 an hour. $2 per item loaded, and they load 5 items per hour. So you could be paying a temp worker $10 an hour, or you could just hire someone, a permanent worker, for $10 an hour, and that would be the same thing, right? Assuming your company is busy enough that the worker has 5 items to load every hour, then it would be the same thing. It wouldn't matter whether you have a temp worker or a permanent worker. However, if your company hires a permanent worker and there's slow times, maybe one day you don't have that many deliveries to make, so the permanent worker doesn't have any work to do, and then what you're going to have is called unused capacity. So if this worker can load 5 items in a truck in an hour, but it only loaded, if it loaded fewer than 5 items, then you have unused capacity. So, for example, if 1 hour they only loaded 3 items, then your unused capacity would be 2 items times $2. So your unused capacity would equal $4. Okay, so hopefully that makes sense to you. When you're talking about unused capacity, we're ultimately going to look at the dollar impact of that unused capacity. All right, and this slide shows a traditional income statement. Okay, so it shows you the total amount of sales, cost of goods sold, here's electricity, wages, delivery costs. It gives you pretty much what you're going to see in a GAAP income statement. But one thing to notice is that these types of income statements aren't super helpful to cost management, to the cost management team. They're going to want something broken down a little bit more. So they're going to want something that looks a little bit more like this. All right. So in this income statement, we have 2 new columns. We have the resources used column and the unused capacity column. All right. So remember the previous slide, it just showed the total amount that was spent per expense. This one breaks it down to whether or not we got use of those expenses. So it provides more information than that previous slide, so it helps us to identify inefficiencies. So it first categorizes the cost into cost hierarchies. The managers can look at the amount of cost in each hierarchy and then find ways to manage those resources better. So let's take a look at this. For loading, red lumber, it spent $150,000 and supplied resources for loading 75,000 items. All right. However, only 67,500 of those items were loaded, and we get that by doing 135,000 divided by 2. So we had unused capacity of 7,500 items, or $15,000. All right. So again, this type of statement shows us how we're using our resources effectively. So 150,000. Remember, each item is worth $2, according to the prior information that we saw. So that means that $150,000 equals a total of 75,000 items that could have been loaded into the truck but were not. And so you do this type of conversion for resources used and the unused capacity. All right, next we're going to talk about the cost management systems used to assign capacity costs. So there's different ways to assign costs. We have to one way is actual activity, and under actual activity, we have to estimate the actual volume that we're going to do. We also have theoretical capacity, which is the amount of production possible under ideal conditions. So they don't give any consideration for maintenance, breakdowns, or absenteeism. So theoretical capacity, you know, I don't really like that. It's extremely difficult to achieve, if not impossible. So it's not very realistic. All right. So again, you have actual activity, which is your actual numbers, and then you have theoretical capacity, which really is not possible in real life, but it's possible, you know, on your books. We also have practical capacity, and that's more reasonable. And that's the volume that could be produced allowing for certain breaks and normal maintenance and downtime. So practical capacity is very it should be very achievable. And then finally, we have normal activity. Normal activity is the long run expected volume of production. So when using normal activity, the cost of used capacity is charged to the product, and the cost of the unused capacity is charged as a period expense. So this allows the manager to track the unused capacity cost and take action to reduce the capacity supplied if need be. All right, and this slide shows the fixed operating cost for a company called Northern Air Charter for the past 3 years. And this second table shows the capacity and cost drivers at different levels. So it looks like this company has room for improvement. Their normal activity is 2,500, but they could have practically as much as 3,200 passengers. Theoretically, they could go as high as 4,000, but as I said earlier, I'm not a fan of theoretical capacity, and that seems to be an unreasonable goal. You know, there's a point in anything where you get diminishing returns. You know, the more you try to improve something, you will improve, but it's going to start costing you a lot more time, a lot more money than probably what you're getting benefit from. I know a lot of companies, a lot of managers will aim for theoretical capacity, but I think most should probably aim just for practical capacity. Because when you're doing diminishing returns, you know, the more effort you put out, the better things are going to be. But at some point, it's going to curve. The curve is just going to stop. It's going to start getting flatter and flatter and flatter. So you're spending more and more and more money, but at some point, it's not going to make a difference. So so if you spend this much money, you know, you're going to be at this level of success, and you spend a little bit more money here, and now you're at this level of success. So it's a very small improvement. So again, when you're getting to the end of this curve, then you're going to have what's called diminishing returns, and you have to take a hard analysis to determine whether or not you want to keep pushing the envelope, trying to improve things, when it's just going to cost you way more time and money than needed. Next, we're going to talk about the cost of quality and TQM. So way back in Chapter 1, we talked about TQM a little bit, and we talked about it being a management method by which some organizations try to excel or improve on all dimensions, with the customer ultimately defining quality. So remember, in business, there's a saying that the customer is always right, and I don't think that's 100% true, but it's pretty close. So there's certain things that you might look at that you might say, well, this activity or this product is worth this much money, but ultimately it's what the customer decides is worth that much money. All right. So unless cost accounting systems are designed to support TQM, though, companies are going to probably find out that TQM has little economic benefit. So again, the customer is generally right, but you have to have your systems in place to be able to measure and determine what the customer actually wants. Because managers are evaluated on the cost of their activities, and so the costs have to be spent wisely. They have to be associated with quality. It has to be incorporated in a way that allows managers to make decisions that that improves or maintains the quality of certain products. So one cost of quality is conformance costs. All right. Now these costs are prevention costs. They're incurred to prevent defects in products, and appraisal costs incurred to detect products that don't conform to specifications. So when a company is producing a certain item, it's going to want certain quality benchmarks. It's going to want, it's aiming for a certain level of quality, and it's going to cost money to make sure that these items meet those standards. Okay, so and how are they going to meet it? Depending on the type of company, you're gonna you might have to inspect materials. Make sure you're using quality materials, process control, quality training, machine inspection, and product design. So all of these costs, they don't necessarily add value directly to certain products, but it's still necessary to have, because you don't want your product to be at an inferior level than you originally planned. You want it to be at the level of quality that you expect and that you're marketing for. So that's going to be conformance costs. It's money that you're spending to make sure that these goods conform to the company's specifications. Now compare that to non-conformance costs. Non-conformance cost is when you've already built your item and it didn't meet specifications. You didn't do it early enough. You didn't catch the mistake early enough, or you just didn't spend the money to prevent this failure. So when an item doesn't meet specification, then the cost to fix it at this point is it's called non-conformance costs. So it's an internal failure when you've detected the problems before you send it to the customers. All right, and then it's an external failures when it's after being sent to the customers. All right, so if it doesn't conform before you deliver the products to the customers, then you're gonna incur costs like scrapping the item, reworking it, re-inspecting, and retesting. When it's a cost that's after the customer receives it, then they could file for a warranty. They could file under their warranty. They might have product liability. Then you're going to have marketing costs and lost sales. So So probably it's best if you're gonna control quality, it's probably best to control it using conformance costs. That way you don't have to deal with failures after the product is completely done. And then the second best would be to catch the mistakes internally before the item gets out into the public, and then in that case there will be external failures such as the ones listed here. And finally, this graph shows how conformance and non-conformance costs are related. So if let's say a company doesn't spend anything on its pre-inspection review, it just says, hey, you know, we're just going to ship out our products, and then if there's a problem, you know, the customers can call for warranty. Well, if it's not spending much money on conformance cost, it's going to spend it on non-conformance cost. And remember, non-conformance cost equals includes stuff like warranty. So you're not spending the time to check your product before it leaves the warehouse, you're going to have high warranty costs, right? Now, the more you spend on these inspections and checks before you send out a product, the less warranty costs you're going to have. So again, the more proactive you are, the less you're going to have to pay in non-conformance costs such as warranty claims. And that's true until it gets to a certain point. Remember I said at some point there's going to be diminishing returns where the more money you spend, you're not going to get back as much bang for your buck. So it shows that at this point, you know, you've pretty much saved a reasonable amount of warranty cost, and you haven't paid too much yet in conformance cost. So it looks like it's a good decision. Now, if you continue, you increase inspections even more, and your quality controls even more. It's going to cost you more and more money. Now, at this point, you're not really reducing your warranty cost by that much. You see, the graph starts leveling out, and so again, the non-conformance costs start leveling out, but the conformance costs keep rising very steeply. So it's going to cost you more and more money to try to eliminate that one or two warranty claims a year. It's going to cost you a ton of money to try to get it down to zero. So that's why I said you have to make a decision. At what point are you just going to be happy with the results, or are you going to keep pushing and spending way more time and money than needed, and then you're not going to get the results that you're looking for anyway.